Folks, would you look at this chart? This is not a penny stock. It's not a meme stock. It's not some stock that Nvidia took a stake in. No, it's the VIX. The VIX, the Fear and Uncertainty Index, the fear gauge, which goes up when people are hedging against uncertainty. Right now, big money managers and people overall are buying VIX so fast that the price is breaking out in a way we haven't seen for years. And we are continuing to see a dramatic mega breakdown in the stock market, and the NASDAQ is officially in correction territory. Stock after stock is being majorly decimated, and the major indices are getting destroyed. You zoom out, this is the most aggressive downtrend we've had since October 2022's bottom hit. And with the VIX, you could tell that markets are expecting far more of this kind of volatility. The NASDAQ is officially in correction territory. And if you look at the past, the NASDAQ composite has fallen into a correction 71 times in its history. And of the 70 previous corrections, about 27 of them continue to fall 20% or more from the recent high, or a little less than half of the time. And so in today's video, I'm going to break down as clearly as possible why the market is falling and what to expect moving forward. We're going to cover 4 major points here today. Number 1, the historical recessionary indicator that just got triggered. This indicator has never been wrong before. Number 2, we're going to talk about markets worrying that the Fed is out of touch with the economy. Are they right? We're going to go over line by line some of the key earnings weaknesses that we've seen over the last month, and the unemployment data that suggests pretty rough waters ahead if something doesn't change really fast. Number 3, we're going to talk about why big money managers like Buffett are liquidating at a rapid clip and forcing the market lower. And finally, number 4, we're going to discuss how to use this opportunity to hopefully make some money. This will be based on previous long-run statistics. And as always, folks, if you're the one taking the risk, you got to be the one also doing the ultimate frisk. Make sure to do your own due diligence before making any kind of decision in any kind of market. Okay, let's get to work. So we need to start with unemployment. Most headlines Friday morning were something along the lines of hiring slows dramatically, fear takes hold on Wall Street. That morning, it came out that the unemployment rate ticked up to 4.3%, the highest since October 2021. On top of that, analysts expected 185,000 jobs to be created in July, and it came out that we only got 114,000 jobs. But these are just the headline numbers, right? Take a look at some of the subsections. The devil's in the details. Temporary employment is being decimated right now. And in fact, if you look at history, temporary employment declines correspond with recessions. You look at a lot of the high-paying sectors of the economy, they're seeing decimations as well. Now, I want to introduce you over to the SOM rule. The SOM rule just hit its criteria for predicting a recession on Friday. The SOM rule basically says that if the jobless rate based on a 3-month average is a half percentage point above its lowest point over the previous 12 months, well, the economy has thus tipped into a recession. Now, this rule has accurately forecast every U.S. recession since the 1970s, and you look at the different times we've triggered the SOM indicator. Well, you have 11 times since 1950 where we did that, and every single time the indicator was hit, turned out that a recession ended up being declared slightly prior to that period, or in the case of 1959, 5 months later. Now, will that happen again? Well, it's very possible the time that we're in right now will end up being declared a recession by the traditional definition, but I mean the data for more than a year has already shown that many consumers are at the brink and many stretching deep into debt. This is not new information, but of course it's an election year, so there's a vested interest in making sure to keep this quiet. In fact, right after the bad jobs report data came out on Friday, Mr. Joe Biden tweeted that the economy is doing great, and he talked about all these jobs that he created since he became president, but Friday's unemployment report from his own run departments show that we erased 2 years of employment gains. Now, I'm not saying that both parties don't do this depending on who's in power, but at the end of the day, when people aren't acknowledging a problem, well, that means that there's not going to be any kind of fix anytime soon. But bigger picture, you have to understand the cycle here. You look at the cycle of economic growth. It starts with individuals producing goods and services. That production provides income in the form of paychecks. Those paid individuals then consume. That consumption then provides revenue. Corporate revenue minus expenses equals profits. Companies then hire more employees to meet demand as more profits are sent throughout the economy, and their enterprise becomes more and more profitable. And that change in demand is what results in positive change in the economic growth overall. And you go back to individuals producing over here. I mean, the problem is when you start seeing stats showing that unemployment is ticking up dramatically and job openings lessening month over month, well, that means that less individuals are producing, which means less are producing income, which means less can then consume. And if less can consume, that means less revenue and less profit for companies, and then a cutting back of employment because demand is lowered, and then you have negative growth. And now that circle will keep spiraling over and over again until you are in a deep, entrenched recession. Now, I know many of you know this chart intuitively. It is just common sense, but think about this for a second. Once any of these steps in the circle are broken, how do you restart them? Once they start spiraling, they spiral on and on and on. So even right now, if people are saying, well, you're just in the beginning of a downward spiral, well, wait a second. But once it starts, it's very, very difficult to turn around. Once any of these steps in the circle are broken, how do you restart them? If there's no demand, there's no demand. Lowering interest rates will help, but depending on how entrenched the economic downward spiral is, that may not be enough. As we saw in the beginning of 2020, as we saw in 2008, 2009, you simply can't ignite demand when consumers are too scared to buy anything. In both cases, we couldn't just lower rates, but we also had to print a ton of money and inject it directly into the economy, stimulus. And that is usually what has to happen in order to restart the spiral in the correct direction. So markets are freaking out that the Fed will cut far too late, and the time will pass where you have no other option but to go to the last resort, which is stimulus, which will then completely be another blow to the US dollar. Money printer go burr, more destroying of the US dollar, more inflation down the road, and a bigger economic spiral further down the road. And that's why also, by the way, you're seeing gold tick up pretty aggressively, especially on that Friday, right? Because that's the conclusion lots of people in the market are coming to right now. Now, of course, at the same time, the elephant in the room here is that the market is essentially priced for perfection. If the stock market was trading 30%, even 20% lower, all of a sudden it's like, okay, well, fine. Hey, we have a little bit of room for risk, but because of where we're trading, well, we're trading for perfection. We're trading for AI to start shooting profits in everybody's bottom line and in their rear end pockets. And maybe in the rear end crack, if you know what I'm saying. With markets going straight up over the last 20 months or so, it leaves a lot of room for downside should the economy start contracting at a rapid clip. And that's why you're starting to see big money managers like Warren Buffett, Mr. Buffito himself, liquidate. You look at Buffett just reported on Friday that he sold half of Berkshire's Apple stake, half. Some analysts are saying, oh, he's just profit taking, a little profito taker. Profit taking is not selling half of your position, folks. Selling half of your position is a major liquidation. You could agree with his decision, you could disagree with it, but the fact of the matter is they are now sitting on a record $277 billion in cash, nearly $300 billion. The total assets at Berkshire Hathaway are $1.07 trillion. So one of the most renowned investors with one of the most impressive track records, if not the most impressive track records of all time, has almost 30% of his fund's assets in just cash. What does that tell you? It's telling the world, hey, we don't see any good deals at these prices. We don't see any reason to be buying in this economy. And worse yet, we think the deals we already bought, like Apple, have appreciated far further than justified, and thus time to sell. In terms of the overall picture, I mean, that's actually what Buffett has said. He said numerous times he just doesn't see good opportunities right now, so he'd rather hold cash, especially considering that treasuries are paying 5-6%. But bigger picture, when you see this level of war bucks on the sidelines, it's not just vapid capital waiting for small opportunities. No, it's capital waiting for a dramatic across-the-board drop in asset prices so that the firm, Berkshire, can start acquiring major businesses at dirt cheap panic levels. This is Buffett making sure his firm follows his advice on being fearful when others are greedy and greedy when others are fearful. And this, he's setting himself up to be real greedy if we do head into a massive collapse. Now, you can let us know down below if you think that he's right on this, but this is just what we're seeing. I'm just reporting what the data shows that people with money and power and knowledge are thinking right now. This is something you're not just seeing with Buffett, you're seeing this across the board with different levels of what could be the beginning of a major liquidation. A lot of people are on high alert right now expecting a increasingly high chance of a massive drop in prices. And should there be more indications of that, there will be massive floors that fall real fast. Okay, let's talk about the Fed and the economy. So the Fed believes that the economy is robust and inflation is down, and thus they are not in a rush to cut rates. That's what they said at the last meeting the other day. Markets may expect some small cuts before year end, but overall, this latest jobs report reaction suggests that markets think this isn't nearly enough. Prominent CFO Neem Aslam said, quote, looking at the numbers, it is very clear now that the Fed has made another policy mistake and the rates should have been cut, and there is no time left. Now, I know a lot of people say, Charlie, okay, this is great. When the Fed cuts rates, that means all of a sudden stocks are going to go boom, boom, pow, pow, like the Black Eyed Peas song from 10 years ago. Well, unfortunately, not exactly, because usually, historically, when the Fed has cut rates, it tends to be the case that you enter into a massive recession if you weren't already in one. And the reason is because the Fed always waits too long to cut rates. That's just the historical trend. You can see almost every single time the Fed cuts rates, you enter into a recession either after, or it's reported that you were already in a recession, but the Fed was looking at some of the early data and they decided to cut rates, but it was too little too late. You look at some of the earnings, I mean, you're already looking at major companies reporting earnings slowdowns or at least some red flags. Obviously, Tesla was one of the first ones. They reported a 45% drop in profits. A huge freakout ensued. Apple, despite strong sales in subsegments, I mean, Apple missed revenue expectations due to weaker than expected iPhone sales, particularly in the China market. The company's guidance for the next quarter also fell pretty short of analyst forecasts. Meta reported declining advertising revenue and increasing CapEx. Amazon reported lower than expected revenue growth, primarily due to a slowdown in its cloud computing division. The company's expenses also increased significantly. Alphabet reported lower than expected ad revenues. You had Hershey's. You look at Hershey's. I mean, Hershey's just reported earnings. It's not like a major company for the stock market or anything like that, but it definitely shows you where the consumer's at. They just had their worst quarter since 2017. Their total overall revenue is dropping like a rock. Not just profitability, but total revenue. Sales are dropping off a cliff. This isn't some super expensive discretionary purchase, right? They own Reese's, Kit Kat, Twizzlers, Jolly Ranchers, a bunch of other popular American candies. People can't even afford chocolate bars anymore. Even Charlie from the chocolate factory could afford a chocolate bar, and his family was dirt poor. They got that golden ticket and they got a lot of money and all that kind of stuff, and now they're rich as the Kardashians. But if you look at their early days, I mean, they still can afford a chocolate bar, but most Americans these days are like, you know what? Maybe I shouldn't be buying that chocolate bar anymore. At the same time, you look at places like McDonald's, Starbucks, consumers are cutting back on their consumption, and these companies are being forced to compete, and they're not doing a great job competing. Even McDonald's tried to raise their price down to $5, and people are like, no, that's not enough. Okay, but great. How do I use all of this uncertainty to make money? Well, one, the VIX. Now, the VIX is up right now after a dramatic rise on Friday, but it'll dump again before its next resurgence. However, we can almost guarantee it'll come back up because uncertainty is increasing and will continue to increase because there's so many different catalysts for that. Whether you're talking economic uncertainty, earnings uncertainty, Fed uncertainty, election uncertainty, hell, even a spiraling war uncertainty. So watch for VIX's next breakdown on Monday or Tuesday and then the next buy. Number two, catalyst plays. So when markets are in a shite storm, traders can find huge opportunities in small cap stocks that have big catalysts reporting like FDA news, congressional buys, AI news, Nvidia stakes, and so forth. In order to find these, we offer a completely free newsletter that sends out reports via email every single day. First link down below, make sure to sign up. It's, again, completely free. We'd love to have you as part of the team there. Of course, our premium picks and research is available in ZipTrader U and ZipTrader Options as well. I'll put the links to those down below, the newsletter link, but make sure to sign up with that newsletter first because you're going to love what we have for you coming this week. Number three, SQQQ. So it's clear that the NASDAQ is seeing downward pressure and a downward trend. We are now officially in correction territory, and the NASDAQ composite, as I mentioned earlier, has fallen into a correction 71 times in its history, including Friday. Of the 70 previous corrections, 27 of them continue to fall 20% or more from the recent high, or 38.6% of the time. And the overall trend suggests some more downside pressure, nonetheless, heading into the uncertain fall. So keep in mind that SQQQ is a key player right now. Anyways, that caps off today's video. Let us know what you think about the economic condition down below, and we'll see you in the next one. Make sure to hit that ravishing like button and subscribe. We appreciate each and every single one of you. Make sure you let us know what you think about this economic condition down below, and we'll see you next time.